Welcome everybody, thanks for attending our interim results. We're going to click through a presentation. First of all, the standard disclaimer, and now just a brief review on our strategy. First point is one key planks of our strategy that we highlighted at the Capital Markets Day at the beginning of this month is to invest in R&D to develop new products, and we are focusing on swine and poultry and mainly products against infectious disease. That's important because there's more people in the world, more mouths to feed, more demand for high quality protein, and the market drivers behind those are very solid. So it gives us a good market into which to research and develop those products. We also continue to develop Aivlosin, targeting both new or underdeveloped geographies and new and unexploited and medical claims. In fact, in this last period, we announced new medical claims released to us or granted to us by the FDA for the US and Canada, and that was around the use of Aivlosin in pregnant and lactating sows, which allows us to target an increasingly large addressable market. Third plank of our strategy is to create partnerships and make strategic and financially robust acquisitions to help develop our core strengths. So that's our strengths in the swine and poultry market, our strengths in Aivlosin, or our future strengths in the new products that are coming through the pipeline. So turning to where we finish this first half year, the big headline is robust revenue growth. All the major regions are performing. The long-term future of the business in terms of our pipeline, we've explained and hopefully demonstrated the value of that at the CMD at the beginning of the month, and those new claims that we have recently got for Aivlosin in the USA and Canada. Next slide, please, Hannah.
Good. Well, thank you, David, and hello, everybody. The financial highlights, a couple of slides here. First of all, around revenue. Revenue progressed nicely during this period, showing a 9% improvement period on period. And here we're comparing the first half of the last financial year, so the 6 months ended September 22 compared to the 6 months ended September 23. So 9% improvement there. That revenue was facing some currency headwinds. During the period, we are about 50% of our business is in US dollars. We then have some exposure to the Chinese currency, the RMB, and a few other currencies, but principally the US dollar, and we saw these currency headwinds. If you pro forma out that currency effect, our underlying growth was up some 15%, which is good, strong progress. We'll have a look at which markets are affected there in a few slides' time. The gross margin, mainly as a result of those foreign exchange impacts that are referred to on revenue, did impact on the gross margin. So the gross margin reported in the period is 41%, down from 45% in the 6 months ended September 22. And that had a consequential effect on EBITDA, which is our measure of net profitability in the period. Reminding you that this business very much is a second half weighted business. It has historically always shown a second half weighting, and therefore it's not unusual that we generate all of our profitability in the second half, given that the overhead base is a fairly consistent 50-50 split across the year. And if we move to the next slide, please. A couple of other highlights, a couple on the balance sheet to start with. Cash balance remained very strong, over £20 million on a consolidated basis at the end of September 23. And that is the same sort of level as we saw back in March 23. Outside of China, and you'll note that consolidated 20 million cash balance includes all of our businesses, including the China business. So looking at the cash balance excluding China, because China has some restrictions around extraction of cash, you see that we've got a nice strong balance of £9 million here in the UK. And that is sharply up from September 22, where it was 4.8, and in fact at March 23, when it was 4.1. So usable cash here in the UK available for investment purposes strongly up. New product developments continued, which we'll look at on a later slide.
And this slide is just to give a little bit more detail on the revenue drivers, that plus 15% excluding exchange, plus 9%. That particularly growth in the US was very, very strong, about 15%. That was because we were able to outcompete some of the competition and we were able to target a beneficial customer segment. So that was very good. China and Japan grew 1.2 million. What was driving that? Well, 3/4 of that 1.2 million is China. And that was continuing the momentum that we saw to the end of our financial year in March. So that continued forward and also some successful commercial activity against some challenging conditions, but we were successful. As I mentioned before, all major regions were growing, and in Latin America, the two main markets are Mexico and Brazil. They continued to grow. We changed our route of business a little in Brazil, and despite that slight change of route of business, so it's now 20% direct, 80% via distribution, that did not interrupt the demand. That change was accepted extremely well, and that in fact yielded the benefits of growth. Mexico, we continue to make progress against the competition. Other parts of Latin America, not quite so good, but overall, as I say, all the major regions in growth. Europe returning to growth after a period of adapting to new regulations. MENAF is a smaller region, and South and Southeast Asia, some growth, but actually we will see more substantial growth, I expect, in the second half of the year because we've got substantial forward orders received from that region. Next slide, please, Hannah.
So of that revenue, let's take it in big segmentation. The overall group revenue chart top left, you can see the traditional second half weighting. In light grey is the H2 period. And if you look at this group over the last 10, 12 years even, you've always seen this sort of second half weighting, which is typically a 40-60 split. Some years 45-55. So that gives you an idea of what we see. The first point to note is that clearly we're seeing growth H1 to H1, which we've previously described, and that is true whether you're looking at the total group or if you break out the China-Japan segment from it. So the China-Japan segment showed growth of £1.2 million, and rest of the world segment shows that consistency of growth. China-Japan, as a general rule, is between a quarter and a third of our business of the group. So clearly we can and we should expect to see a second half weighting in this financial year, as we've seen previously, driven in the main by disease timing. So it's very much a seasonal disease outbreak, and that drives the use of Aivlosin, which is our primary product. I think the other thing to mention on this slide, you'll note if you read the interim statement that we declare that we have coverage of 94% of the consensus revenue for the year. Consensus revenue we've mentioned in the release. Now, where does that 94% come from? Well, clearly we've got 6 months which we're presenting here. We've also got October and November to date. So those are revenues that we've recorded. We've got an order book which gives us some coverage as well. And in those markets where they are markets which are satisfied, or the orders are satisfied from stock on hand locally, we use a run rate basis for measuring what the forward loading looks like. And if you use the October numbers and do 5/7 of that, that then gives you that 94% figure. On top of that, we've got some markets where we expect orders and we're not measuring those. And furthermore, we have the seasonal effect, which I've just described, where 5/7 of October's number does not reflect the seasonal effect we see in H2. So we've got a very high confidence of achieving the revenue consensus for the full year. Moving on to the next slide, please, Hannah. R&D expenditure is clearly a big feature of what we're up to. Those of you that may have seen our recent presentation of to the Capital Markets Day, we hosted a similar webinar a few weeks ago. We described in a fair amount of detail what we're spending the money on, what the key projects are that are coming through the pipeline, what stage they're at, and what they're actually tackling, and what their prospects look like in terms of peak revenue and timing to market. So this slide really just captures how much are we spending, and in the 6 months period we spent £3.6 million in cash, 1.5 of which was capitalized because it relates to the expenditure on our 2 late-stage poultry vaccine projects to treat mycoplasma. And because they're late stage, they're in the development phase, therefore they're capitalized and they end up on the balance sheet. 2.1 million was targeted or spent on earlier stage programs, and therefore that hit the P&L. Moving along to the next slide, please, Hannah. We look at the other element of overheads, which is admin expenses. And if you look at the September 23 number, it's almost exactly 50% of the full year for 2023. So the steer here is that admin expenses are very much in control. Within that, I would indicate that notwithstanding that we're seeing 50% in 6 months of the previous 12 months, clearly within there we saw some inflationary pressures in salaries, which I think most businesses operating certainly in the UK would have seen those sort of salary inflationary effects, and we were able to offset that by some savings elsewhere in the P&L, principally around legal and professional, some audit fee savings and so forth. That helped to offset those inflationary pressures we saw on personnel. Moving along to the next slide, and coming back up the P&L for a moment, we'll look at gross margin. Now, our figures did see a reduction in gross margin, where we reported a gross margin of 45.3% in the first 6 months in 22, 40.8%, so 41% in September 23. The five key elements of that movement are set out on this bridge, and the biggest of which being the foreign exchange impact on revenue. I mentioned right up front in the highlights section that we saw a 9% growth in revenue, 15% on a constant currency basis, and this 3.5 percentage points reduction in gross margin was from that FX effect on revenue. It was a currency headwind. So that moved our gross margin down 3.5 percentage points. The converse of a headwind on revenue is a tailwind on costs. And so the second column, the 0.9 percentage points increase in gross margin, that came from the fact that where we had costs in foreign currencies, they were in our favor, and that helped the margin. Now, why I hear you ask, is the 0.9% out of kilter with the 3.5%? That doesn't seem to be in the same kind of ratio as you'd expect. And that is because on revenues, we're exposed to more currencies. We're selling around the world in local currencies, whereas in cost of sales, we're manufacturing a majority of the group's products in the UK, hence no FX impact. The only FX impact we see is in our manufacturing plants in China, in our manufacturing plants in the US and Canada. So that's why the 0.9 is proportionately lower than the 3.5. The other element of input cost into cost of sales is API, the active pharmaceutical ingredient cost. API is about 2/3 of our cost of sales, so it's a very large component of that. And that is purchased in dollars, in US dollars, so hence we have some FX exposure. And it's also purchased well in advance of the sale happening. And it can be, and typically it's between 4 and 6 months in advance. So hence, not only do you have FX to take into account, but the timing of the FX. And in this case, it was unfortunate that turned into a headwind as well, rather than being a tailwind. The fourth column, China depreciation, this isn't a new cost. It was simply that in the September 22 period, our China factory was being refurbished, and accordingly, the depreciation on that China factory was charged to overheads, not to cost of sales. We're now back in production, therefore it's a cost of sale. And so it's a reallocation across the P&L rather than a new charge. And the final item, the 0.3%, is a monthly charge we get from one of our UK plants. It's a surcharge to cover increased costs of working, principally energy. So it's an energy surcharge, which when the energy prices and costs reduce, that supplier will reduce this supplementary charge and we'll get that back. So looking at all of that and giving you some sort of idea of what is recurring, what is one-off, and what is reversible. The last two columns, the increased costs, so depreciation and cost of manufacture, these are, we'll see these as a feature in the second half, but not to this extent. So a 0.5 percentage point and a 1/3 percentage point. Those are fixed monetary amounts, so the percentage impact will be smaller in H2. The API inventory sales lag, that should reverse in its entirety in the second half because we've already purchased the API during the first half to satisfy second half sales. So we know what that cost is. We can see it reversing. And therefore, that just leaves the FX impact on revenue and the other elements of cost sales. And that will be subject to what the exchange rate is at the time of the transaction. Suffice to say that during October and November, those two items were very much in our favour, and so a headwind on revenue has become a little bit of a tailwind on revenue. Who knows where it will go for the rest of the year, but looking good so far. Moving to the next slide, please, Hannah. EBITDA, our measure of profitability, the bridge there from H1 22 to H1 23, the component parts we've pretty much already spoken about, so an increase in revenue, a reduction in gross margins, admin expenses which were higher in this H1 compared to H1 last year, principally as a result of personnel costs, which I mentioned earlier. More of the R&D expenditure being focused on late-stage projects and therefore being capitalized, therefore contributing to improved profitability. Thank you, Hannah.
So just bringing this together really in a quick summary, strong revenue growth. We're growing across the world, all of the major regions. We've had some headwinds in gross margin explained by Chris for the foreign exchange. The cost of goods reduction that we got has now worked through. We are now selling API at the lower cost that was negotiated earlier on in the year. That didn't flow through fully in H1, so we can expect that to, and that will flow through in the rest of the year. And the inflationary pressures that we saw, they've eased somewhat. We haven't had to increase salaries in the same amount. There wasn't that requirement to do that in the same amount this year as there was last year. And we do have levers over the expense control that gives us flexibility for the future next part of the year. Moving on to the next slide is a brief update on ESG. Nice to be able to share with the attendees good progress here. As part of our ESG commitment, we went through an independent audit that was one run by Interim. They're used by quite a large number of companies, and in fact, in our peer group of life science, there are 300 peer group companies, and we were very pleased to be awarded an A rating, the highest possible rating. And in fact, we were the only company in our subsector peer group to achieve such a rating. So it's nice indication that we are committed to this area and we're making progress. There's also future progress to make, For example, we're doing a materiality assessment across our business, both internally and externally with our customer and suppliers. And we continue to note that we aim for carbon neutrality further on out. 2045 is what we have. We're continuing to track our emissions and other data that helped us get the A rating. We're continuing to do that and expanding that through our global operations. So brief summary on the actions and achievements on the ESG side of things. Moving on back to the financial piece of the balance sheet.
Yeah, indeed. Thank you. Thank you, David. We've, as usual, called out a few of the working capital ratios here, and very pleasing to see improvement in all areas. So stock days reducing, more than halving since September last year, down to 141 days. Debtor days heading down towards the magic 100, and hopefully into double digits at some point. And that has really resulted in this improvement in cash, which you see on the face of the balance sheet on a fully consolidated basis, and stripping out China, you see the UK-based cash more than doubling since year end. And I think those sort of working capital numbers really do feed that improved liquidity that we've got, and cash position available for investment. These are still some quite big numbers on the balance sheet. We're below 20 million pounds of inventory, but 20 million pounds is still quite a lot of cash tied up, together with another 26 million pounds in trade receivables. So needless to say, I should be continuing to keep the pressure on these areas to see how much further we can lean these out. Otherwise, it's a strong balance sheet, and one which we're working efficiently. Moving to the cash flow statement, the next slide. Those same comments you see in cash flow terms. So the net cash generation from operating activities largely generated by working capital improvements, which we've just described, and that then being deployed in terms of purchase of intangibles. That's code for capitalization of R&D. So that's those two mycoplasma vaccines, which are now in late stage. And the other largest item of cash deployment there is in dividends paid. And this is where we are repatriating cash from China. The mechanism for that is a dividend. And our joint venture, where we own 51% of it, when we declare a dividend from that, clearly the 49% joint venture partner receives a dividend, and this is cash leaving the group. So that's what that item is. Moving on, please, Hannah.
So now looking forward to our R&D portfolio and what we can expect out of that. This slide shows in the large green teal bubbles the different projects and the expected peak revenue of those. So you see a mix here of near-term assets and medium-term assets. So the late-stage near-term assets coming to market soonest: Ecovaccine MG and Ecovaccine MS. Those are now trademarked poultry mycoplasma vaccines. The smaller green circle is the R&D costs left to go. The large blue circle is the peak sales, and the yellow laurel is the expected approval date. That's the yellow laurel circle. So what you see is we've got a number of late-stage assets, some medium stage assets of very significant value. At the CMD, where I'm borrowing this slide from, we went into a little bit more detail in all of these projects, but in essence, suffice to say that we've got a large number of high-quality assets near term going to deliver revenue, and some, particularly the larger bubbles, of great innovation, and which can have the potential to really benefit our customers and really benefit our business in a transformative way. So this really summarizes our late and medium stage assets, and you can see the revenue and the costs and the expected approval times. So we are really doing well there. Another piece, thank you, Hannah, onto the 3 Cs. The eco values, Another piece of improving our operations, professionalizing our operations, we did our first employee engagement survey about this time last year. A couple of things came out of that, of which we wanted to crystallize more clearly the eco values. So we've put this into collaboration, commitment, and curiosity. Collaboration talks about working together, and we have quite a large disparate global business split into lots of different functions. So collaboration between finance and regulatory, between R&D and regulatory, quality, finance, critical for the future of our business. We have a very good, well-motivated employee base, which we're delighted to have, and their commitment is absolutely critical. So we're wanting to show that and highlight that in our values. And curiosity, the last he talked to really the curiosity around the science, the curiosity around trying to do business better. Curiosity is another word for innovation, if you like. Innovation is perhaps overused a little bit in R&D parlance, so we went for curiosity because it also embeds a little bit of curiosity about how to do business better as well. And we progressed to try and improve our business by embedding these values both externally, as we're doing now, and internally. And moving to the last slide and the conclusion, mentioned many of this, but I would just like to double underline and ditto a couple of things. One is that the revenues are nicely growing, on track and per prior guidance. We have great confidence in the second half of revenues that we will continue to deliver for the reasons mentioned earlier, but that is we have a large, substantial order book, the months that we've already got in hand, and the expected run rate, which if you take the first half run rate, historic seasonality of this business shows that the run rate in the second half is larger than the first half. So by doing that, we've got at least 94% of the consensus covered. The other 6% comes from the orders that we get on a sort of weekly, day-to-day business, and that improvement in seasonality. We've already seen, second bullet, we've already seen post-period end that we're reporting now. In October, we had improvements in the gross margin in our management accounts by about 3% to 43.5% in the month of October. The API pricing, as I mentioned, is flowing through now. All of that and other things allow us to expect that the H2 GM will improve. Mix is another one. That means geographical mix that tends to improve in the second half of the year, typically. On top of that, as mentioned at the CMD and just now, we have a great, exciting pipeline ahead of us. We are making encouraging progress there. We're seeing those assets maturing, and will deliver in the relatively short period, as shown on the last slide. So I hope that's given everybody a run through the business, the results, and also the conclusions of the outlooks. And I'll turn it back to you, Hannah, in case there are any questions. Thank you very much.
Can you expand how you managed to beat the competition in the US?
Yes. One way is that we were targeting a different segment, slightly smaller sow farms, slightly smaller entities. So segmented, they're all relatively large farms, but we moved our focus to slightly smaller, who were less impacted by some of the negative economic conditions. That was one reason. The other reason was that we were a bit more focused than the competition and a little sharper. I think there was a degree of we're experts in this business. We know this business, and not everybody is as focused on swine and therapeutics in swine as we are. So I think it's focus and segment as the two main reasons for that.
Thanks. Did I understand from your introductory comments that you are looking at acquisitions? And if so, is this something new?
We are looking for acquisitions or partnerships. We already have a number of partnerships around the world, so that piece is not new. We have some cash. We want to develop the business. We're spending most of that cash in R&D at the moment, but it's sensible for us to look at acquisitions, mergers, or partnerships for our commercial business as well as for our R&D business. We would look more to focus on our commercial business and developing that out. Why? Because it's strategically a sensible thing to do, because we have a route to market already, and more things that we put through that route to market, we will get operational efficiency, and that will drop to the bottom line. Of course, in my first slide, I said it's got to be strategically and financially robust. So we make that assessment. It is not particularly new, but we are putting a renewed focus on that. Also to set us up for our future portfolio. That would be another good strategic reason to do it.
Thank you. Can I just ask the attendee who's raised their hand to submit their question in writing, and then we'll be able to put it to the management team. You touched on this point actually in your last answer, but there's another question here. Given the stronger cash position, are there any plans to accelerate R&D? But I think the answer is yes. Would you like to expand on that?
Our focus in R&D at the moment is to do focus and finish. You know, we are pregnant with innovation. We've got lots of opportunities. What we need to do is to make sure that we spend the money to bring those to market in the right way as soon as possible. So yes, we look to fund R&D as best we can to do that.
Thank you. Few here. Can you just contextualize how significant an opportunity you see new medical claims being for Aivlosin in terms of additional sales?
If I take the one that we announced this half for US and Canada, that's the usage in pregnant and lactating sows. There are about 6 million sows in the US. The replacement rate, meaning how quickly they get turned over, how many gilts come in, is around about 40%. So you've got new gilts and sows coming into the herd all the time. And this gives us the opportunity to treat pregnant and lactating sows. So sows are pregnant and lactating for a lot of their life. So it gives us the opportunity. Broadly speaking, it gives us access to a market that we've had off-label use under veterinary provision access to before. Now we have absolutely on-label use. So it gives us more permission. In terms of size, overall, it's several $100,000, I would imagine, a year, growing to a little bit more than that.
Are you able to give a ballpark of where gross margins might land in the second half, given where FX rates currently sit? And how should we think about gross margins looking forward?
I think if we take our October management accounts as some sort of indicator of what the full year might look like, its margin was more towards last year's margins, so closer to the 45% than to the 41%. The current exchange rates are not as favorable as they were in October. The US dollar, I think this morning, was 127. So heading away from the October levels, but nevertheless still favorable compared to where they were earlier this year. I wouldn't pretend to be an FX predictor, but that's certainly to date it's favorable. There are the other elements that I described earlier on in the gross margin mix. So, for example, the API and the cost of goods. So those things are in our favour. And I would indicate to the audience that gross margins for the full year, because of the first half at 41%, they won't be at 45% for the full year, but they'll be heading back that way.
Okay, thanks. Obviously, more R&D is going to be capitalised as the poultry vaccines continue through the later stage of development. Can you give a sense of how the weighting of expense to capitalised costs will look over the coming years, given what you outlined at the Capital Markets Day?
Yeah. So for this year, we're indicating 1/3 of our cash expenditure will be capitalised. So that's the guidance we're giving for this year. Looking to next year, clearly that's then the year in which we should attain those marketing authorizations. So that's the final year of the mycoplasma projects. The expenditure for next year compared to this year on the mycoplasma projects is roughly the same to bring those through to the end. So one would guide to the same sort of degree of capital versus expenditure split for next year as this year.
Okay, thank you. You mentioned in the results announcement potential for M&A, and I think you've slightly touched this, but what exactly are you looking for?
We are looking for something that fits with our portfolio, fits with our future portfolio, so into the segments where we are, so at geographies where we are strong, therapeutic areas where we're strong, swine, poultry, preventatives and/or therapeutics in the regions where we are strong. That's broadly the place that we're looking. We can look for both individual product or products, which may be spun off from other companies or are underutilized assets in other companies that we could utilize better. There is also, so it's products or portfolios. There is also the option for an entire company, but that would need to be of the right size and financially robust and at the right price for us to do that.
Okay. This investor is looking for a little more detail on how you on your sales channels, given that you sell in 70 countries. Do you have people in Mexico, Brazil, US, and Japan who are employees? How much of your receivables book is with distributors and how much by the end client? It must be very costly and inefficient to service clients in these countries with smaller sales.
Well, what a presumptive question. Let me answer the first bit. Yes, we do have people. We have a joint operation in the US. We have employees in Brazil and Mexico and in the fourth named country, Japan, and indeed others. We operate mainly via distribution, which actually is an efficient way. So we have a distribution partner very often, and then we have staff that will do work alongside distribution to provide, for example, technical advice, veterinary advice, as well as specific commercial key account sales activity. So we have a logistic partner and a distribution partner, and then some specific staff. In terms of numbers of employees, it's not very large. We have around about 100 full-time employees around the world. So in some of the 70 countries we are operating, it's almost all done by distribution. In those big markets, those ones that you mentioned, plus a few others, China, Japan, Mexico, Brazil, and US and Canada will be the areas, and Europe will be the areas where we have most of our employees centered. The other markets, we're operating entirely via distribution.
Thanks. A comment on that R&D pipeline slide. It looks like that only after 2026 we will see the large revenue growth, more than 15%. Are you, well, so I think the question is then, are you looking to deploy more cash for acquisitions? So perhaps we have covered that off in terms of uses of money. And another question here is around, do you think the share price accurately reflects the value? I would point people to our research in terms of guidance of what we think, and I know the management team will probably endorse those views, but also can shareholders expect a dividend in the next 12 months? It sounds like you've got a lot of uses for cash.
We do. Taking the first one, how fairly valued are we? We think we are, of course, we would say that we think there's much more value in this company than is actually being seen right now. Why is that? Well, one, the market for small cap is not great at the moment. Well, I think we all know that. Second reason is, very simply put, the value of our future portfolio is not being dialed into the share price. So either we're only being valued for one side of the business, and the other side of the business you get as an absolute freebie at the moment of the current share price. So there's some specific eco factors where we're undervalued, and there's some market factors that are probably driving that valuation as well. Second point, I think we've covered the cash deployment. We're not declaring a dividend right now. We think we cleave much more to a growth company, and there's a number of, as you nicely put it, Hannah, there's a number of ways that we can deploy cash to grow the value of this business quicker.
Thank you. There's been commentary in the financial press of low hog prices in China. How are you seeing the market in China in the next few months?
We've seen that price dogging the market for a little while. The forward-looking analysts continue to show relatively low pricing for this quarter that we're in, this calendar quarter, and improvements next quarter. I'll reference Boyer, No Swine, and a few others that are predicting that. So improvements to profitability in the early 2024. That's probably borne up by what we see in the market as well. I think one of the backgrounds to that is that the demand increase post-COVID didn't really come through, or at least came through much slower than expected. However, we move into timings of increased consumption of pork, typically in China, around Chinese New Year and holiday periods like that. That tends to support seasonal increase, and there's other factors that would also, I think, underline what the forecasters are saying, which is improvements by early 2024.
Okay, thank you. Diageo has been caught out by lack of visibility of distribution inventories. Are you happy with your visibility?
Thank you. That's a great question, because actually we didn't answer that question from the earlier one, my mistake, because there was a similar question. Are we happy with our distributor inventories was allied to an earlier question. 2 points there. Chris mentioned that our inventory holding is down. It is much more costly in this business to lose customers by not having product available and going out of stock than it is to hold stock. That being said, every good CFO and every good management team wants to manage that down to a good amount. We do have visibility on much of our distributors' holdings. Some they disclose completely, some partial disclosure, and where it's partial we can calculate because we know what we've sold to them, and we've got good ideas of what they are selling out. So in general, I would say the answer is yes. I'd much rather make sure that we have product available at the point of sale at the time of sale. So if we err slightly on the cautious side to make sure that we've got the inventory, but we do monitor the inventory and make sure it's not above that kind of 3-4 month level across the chain. So I hope that answered that question and the one that I didn't answer before.
Well remembered. Final question. Any plans to manufacture products in different geographies or regions?
Another good question. We have looked at this, continue to look at that. It's perfectly possible to do. The technology is exportable around various parts of the world. You need fermentation capacity, and the right requirements, the right sort of licensing. One thing that we also take into account is cost, and we want to make sure that the cost is at the right place. And there's certain parts of the world where if we were to make, we know that the cost point wouldn't be helpful for our P&L. So we look at that, but we won't do that unless it's sensible at a sensible cost point.
I think we went through a bit of a rationalization process in operations to shut down a few of our contract manufacturing organizations who were doing smaller volumes, and as ever, it's easier to manage fewer who are doing more volume. That said, we switched another one on in the last year in Greece to service our EU market. Now, post-Brexit, it's a lot more difficult to service the EU market from the UK. So we've got a finishing plant in Greece, which is servicing that arena.
As a CMO.
As a CMO.
Lovely. Well, thank you both for your time. Thank you to our attendees for their questions and their time. And we look forward to hearing from you both in another 6 months.
Super.
Certainly.
Thank you very much.
Thank you for hosting, Hannah. Thanks for attending, everybody.
Bye-bye.